Hello everyone, welcome back to the Volatility Grid lecture series. We're going to be going over AMRP projections in this lecture. Many of you already know what AMRP stands for, Average Model Range Probability. It's a data-driven concept used to define the expected range of movement within a specific time. But today we're going to be talking about what happens when price breaks outside of that expected range. And more importantly, what kind of projections can we anticipate when that breakout occurs? So these are the settings for the intraday and weekly models, AMRP projections. You can turn the AMRP on or off, and we've now added projections here. So these are projections based off the AMRP zone, which we'll get to in a moment. And you can add custom zones here, as well as the standard zones or projections with these zones. You can also show historical AMRP projections from historical models, or if it's too much noise, you can turn that on or off. So this is what it would look like. As you can see, price is extending and breaking down in the next model. As soon as the body closes beneath the AMRP deviation zone, it then quickly plots the projections. We have a -1, -2, and etc. This happens during expansion periods and breakouts, aka higher volatility. At its core, an AMRP projection, these blue boxes, is essentially the expected average model range. So we're looking for premium prices and discount prices here. However, because it's based on historical volatility, sometimes on specific days, there's just going to be a large amount of volatility. And when price extends beyond that, it's not random, it's structured. So it tells us that there's something more powerful at play here. And that something usually tends to be the higher time frame. Too often, we quickly assume that because it's running past AMRP, it means the model is invalid, but that's the wrong interpretation. Sometimes there's breakouts, and breakouts from AMRP zones are opportunities to project, not just fade. And if you can understand where price is rebalancing to, you can actually use the AMRP zone projection as your draw liquidity, and then look for a trade outside of the zone. Oftentimes you'll see this because it's rebalancing the higher time frame. So in the previous example, you can see how it pushes back down and breaks out. This is a weekly model. And on the daily chart, it's pushing back down into a gap, a void. So whenever we're rebalancing the higher time frame, it tends to be because of large movements, large bodies, large ranges that occurred, and or oftentimes gaps, a gap that needs to be efficiently filled. So a breakout beyond AMRP is often due to one of these two things, and sometimes both. It either needs rebalancing on a higher time frame imbalance, or there's just a continuation leg within a trending market, and it needs to retrace before continuing to expand in the desired location. So for example, if we're in a trending daily environment, in this example here, and price is expanding off because it's left in inefficiency here, we can then possibly expect price to come back, rebalance that fair value gap here and or this void. And what that would look like with AMRP zones, you'll see it have a bit more volatility than usual, breakout. Confirmation is a closure beneath this zone here, and very quickly the indicator plots the projections. And so if we're looking for a breakout, we're looking for these levels to be met. This can also be used for possible reversals, but more on that later. Let's look at a couple examples here as we continue before concluding this lecture. To wrap this lecture up, I want to walk through a couple of live chart examples where price broke cleanly beyond AMRP plus or minus, and we'll use this to show how the projection played out and what the higher time frame context was, and why it wasn't just a random extension, but a structured, logical continuation. And remember, AMRP is a starting point, this blue zone here, but projections give it direction in case of a breakout. So here I have gold futures. We are on the 1 minute time frame, and I am simply looking to see when price breaks out, what's a confirmation that it wants to go lower. I like to observe fair value gaps and efficiencies in the market because there's often displacement followed with a breakout. So as we can see here, price closed beneath the AMRP zone with a body and left an inefficiency on the way down. Because it broke down, I will then look to see how is it going to interact with this fair value gap. If it respects it, then I can possibly expect these projection levels down here. We have a -1, -2, and -2.5. Now, oftentimes, when price does break out, because we're looking at a model from this time to this time here, this is how far price really should just surpass the breakout. As we can see, it's pushing quite viciously on the way down, but in this specific time slot, I really just want to see price snap into here and push back. Upon the next time slot, well, it's a different time, so we could possibly see different volatility. As we can see here, retraces back up, and at that specific time, 11:49 a.m., it retraces all the way back down. So when I'm looking at this breakout, we repeat the process. This fair value gap here, there's another one here. That's why I like using fair value gaps, because when there's breakouts, there's often displacement and inefficiencies. So if price is respecting this fair value gap and these projections are pretty close here, I will then look to target any further projections here. Let's say it's just a really powerful move and AMRP zone is pretty small and we're just seeing a lot of volatility. Well, again, I can customize this projection to keep following price here in a logical way. So if I'm looking for price to just be really extremely volatile, I can add a couple of projection levels to meet that criteria. Oftentimes when price far exceeds its volatility, on the next model, I like to see price return back, at least into the premium in this case, AMRP zone, or oftentimes you'll see it just snap back like a rubber band, and think of volatility in that regard. Far extends down, snaps back, and I have some targets here. So this is essentially an example of price returning back to its fair value and or perhaps filling a higher time frame inefficiency. And this is another example here. So let's proceed to the 50-minute, and we can see there's likely going to be an inefficiency on the way up. As we can see here, there's a fair value gap nested inside this price leg. Now we will keep this on the chart and we'll keep note of that. So if we proceed back to the 1-minute time frame, we'll then see that upon this vicious downward move to the sell side, the next model extends back to the premium AMRP zone and has the same exact scenario, a breakout. Why? It's trying to fill this inefficiency. So there's all types of trades that we can take here. I will leave that for a different day as far as examples of that. But this is the framework. It essentially is a breakout of the AMRP statistical zone. And I like to use fair value gaps along the way. This shows me that if there's displacement, I will look for price to reject off of it and continue lower. Vice versa, if there's a fair value gap here, I will look for price to hold that fair value gap and continue higher. This is a repeating phenomenon that I like to observe whenever I'm trading intraday or perhaps swing trading using the weekly models. It is the same exact framework. This is a current live environment, Asia, as we're seeing it's breaking down from the premium zone and extended down to the -2 and very close to the -4. Ever since then, it's coming back in. But what are we going to observe? We're going to observe this fair value gap here. If price is really weak, it'll continue lower back into these levels, and we can look for scalps into that. I hope this brought some insight into the deviations and the projections from AMRP. Until next time.